Come back to it, but Disney stock, as we say, tracking a little bit higher. Let's get back to geopolitics and talk about what is happening with China and Taiwan. Alex, we've got yet another congressional delegation, this one led by the Democratic Senator Ed Markey. It's in Taiwan. Of course, this is just 2 weeks after House Speaker Nancy Pelosi's trip, which led to unprecedented Chinese military exercises. This time round, China says it is fighting back by adding more military patrols around the island, but it basically maintains a high level of tension surrounding Taiwan. Why is this happening? What are the implications? Anne-Marie Jourdan, Bloomberg's Washington correspondent, joining us now from D.C. Anne-Marie, talk to me about why this is happening. This comes hot on the heels of Nancy Pelosi's trip. Were the two planned together? How is this going down in D.C. and what are the implications?
Yeah, a lot of these trips are planned well in advance, and this one is getting a lot of press because it is on the heels of Speaker Pelosi's trip. And what we saw to that was, of course, as you mentioned, Guy, this unprecedented action from Beijing in terms of these live fire drills, also the likely what was ballistic missiles flying over the island, with Japan saying they've landed in their economic exclusion zone. Also the fact that China pulled the plug on climate and defense talks with the United States. And now just less than 2 weeks later, you have yet another member of Congress, of course, completely different ranking than the Speaker of the House, but still another member of Congress making their way to Taiwan. But over the course of the Biden administration, there's been more than 30 lawmakers that have visited Taiwan. The reason why there's a spotlight now, so much of that is because it was the Speaker of the House. I think there's also something to say that Xi Jinping has a very important few months ahead. They have this major Congress where he's going to get this president-defying third term. At the same time, you saw the data today. He's dealing with a lot of issues at home.
Yeah, indeed. But you have to wonder, though, does President Biden want all this right now? It kind of distracts from the overall message at the same time. Anne-Marie, thanks a lot. Nice to see you back. Bloomberg's Anne-Marie Jourdan joining us there. So coming up, we'll get back to the markets here. Investors are waiting U.S. retail sales on Wednesday. We also have Walmart before the opening bell tomorrow. We get Target this week. We're going to speak to Michelle Meyer, a chief U.S. economist over at MasterCard Economics Institute, about the state of the consumer and can the spending hold up enough to avoid any kind of recessionary impulse here. The S&P off about 0.3% around the lows of the session. This is Bloomberg. Let's get back to the breaking news here. Disney stock up by about 1.3% off the highs, but still up. Third Point accumulates a position in the stock and looking for a board refresh. Let's get more on this with Creighton Harrison from Bloomberg. He joins us now on the phone. Creighton, what do we know about what Third Point wants to do here?
Yeah, they have several suggestions. I will stress this seems like a relatively friendly outreach. Certainly Dan Loeb prefaces the letter with praise for Disney's most recent quarter, where they beat estimates quite a bit. But then there are several suggestions, and Loeb acknowledges, hey, some of these might already be in the works, but we just think they'd be good ideas, right? Go ahead.
So, Creighton, to that point, I thought the numbers last week were okay. I thought this was moving in the right direction.
Yes, and that's why I think this is a pretty nuanced letter. I mean, he actually does praise ESPN specifically, and yet later on the letter is calling for it to be spun off. He thinks that this would be a good way for the company to pay down debt and have more strategic options eventually. So it's a little bit of a mixed letter in that way. It's both saying, hey, you're doing a pretty good job, but there's some things that I think you could do even better. That also includes combining Hulu with Disney Plus, which would require Disney to do a deal with Comcast.
Interesting.
Yeah. That would be interesting, actually. Yeah. Creighton, thanks for jumping on the line. Really appreciate the updates on what is some fairly breaking news surrounding Disney and Third Point's position. Obviously, regulatory requirements need to be satisfied for this all to happen, and certainly that conversation to take place in more detail. Let's get back to the week ahead. Retail earnings going to be a huge feature of the landscape. The retail number Wednesday going to be a huge feature of the landscape. Inflation may be showing some signs of slowing in the United States. I guess you got to pick your points. This week, investors will get a read on the health of the consumer, which is going to be really important in understanding this. Remember last earnings season, Walmart, etc., caused some real ruptures in the markets. Last week, we spoke to Joanne Shu, University of Michigan's Surveys of Consumer Director, about consumer confidence and consumer trends.
People are not really feeling good about their economic circumstances or the overall outlook over the year. We haven't seen a lot of pullback in spending so far, but that could change very quickly if inflation picks up again, and particularly if labor markets start to weaken.
Joanne Shu joining us after the release of the University of Michigan data Friday, which was mixed, I think, is probably the best way of describing it. But nevertheless, the consumer trends that we're seeing in that data series are actually quite negative. Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist, joining us now ahead of this big week. Michelle, what do you make of where the consumer is right now? What are your data telling you about the state of play?
I think that your prior guest just described it very, very well, which is that consumers have been facing high inflation. They've been facing high prices, particularly for things like gas and food, although recently in the last month or so, gas prices have come down, which has been a really nice welcome. The labor market has remained very robust. They still have income flowing in, but they're apprehensive about what comes next for the economy. So clearly the surveys have shown that consumers are worried. They're trying to plan ahead. They're trying to think about how to navigate this economic environment. But in the interim, they are still out spending. When you look at nominal spend, when we look at our own data, MasterCard Spending Pulse data, you are seeing, still very solid spending trends.
Yeah, that was something we took away from Joanne. Like, no one feels good, but they're still buying the stuff. What stuff are they spending on?
So there's been, pretty decisive shifts in how consumers are spending. Certainly the theme throughout this summer has been one of experience-based spending. We are seeing, very, very strong and consistently strong spend on travel, on restaurants, on recreation. So people going back out and living their lives again post the COVID period. Goods-related spending has been weaker. It has not fallen off a cliff by any means. There has not been a acute drop. But you have seen some navigation away from certain types of items, and consumers are just trying to figure out how to balance their consumer trends. And they're also responding, importantly, to relative price differences. So you have seen consumers making some choices where, in certain categories where prices have just increased in a painful way, they're looking to shift towards other types of items which are a little bit more absorbable when it comes to those prices.
Michelle, how is this spending being financed, and are we seeing a shift?
So when you look at, the data, so the Federal Reserve consumer credit data, for example, you certainly have seen an increase in credit card spending, a pretty meaningful one throughout the quarter, the second quarter. And that makes sense because if you look at what happened during the pandemic period, there was, a drop in credit card usage because of the stimulus funds that were coming in, because of the quarantine, people staying at home, not necessarily needing to spend as much and accruing savings. So you have seen a re-engagement from that Federal Reserve data in terms of credit card usage. You have seen some drawdown in savings, although really only modest so far if you look at overall aggregate levels of savings. And remember, income is still flowing in. Look at that last jobs report. It was extremely strong. So aggregate income is still increasing at a healthy pace.
Yeah, and we saw in the UMich report that those with lower incomes are actually feeling a bit better because of the wage increases there. So, Michelle, I'm curious as to what happens October 1st, because presumably everyone's back in school, right? You said airline sales are up over 13%. Lodging is up almost 30%. If that stops, what's your visibility? Are we going to still spend stuff and buy things, or are we just going to stop?
Yeah. So I think, you kind of continue to see these seasonal switches. So remember, we're looking at year-over-year changes or 3-year changes. So those seasonality adjustments are embedded in those percent changes, right? So you do see the consumer move from the travel period of the summer to a back to school type of spending to, perhaps starting to get ready for the holiday shopping season, which gets pulled forward quite a lot. If you look at the last 2 years, October, you're well into the holiday shopping season already. So I think the preferences do change, seasonally, which makes sense. I think the bigger question, though, is, does the economic environment change, which really adjusts purchasing power for the consumer, and that really goes back to the labor market. I think so much rests on, what's the state of play for jobs? Do people still have their jobs? Do they expect to have their jobs into the future as well? That's going to be the critical factor for how consumers fare into the end of the year. Their preferences will change. Their priorities will switch, of course, but it's are they employed, and do they expect to continue to be employed?
Michelle, how fast is the housing market slowing down?
So that's a sector that's been fascinating to watch because there has been a pretty decisive slowdown. I mean, look at the data we just got this morning in terms of the home builder confidence survey, which now fell below 50. That makes sense given what we've seen from home sales falling, from home prices starting to certainly moderate in some areas and maybe even fall in some really specific MSAs. So the housing market is under the most amount of pressure. That's where you have the biggest impact from interest rates. That's where you've seen, in some sense, a post-pandemic adjustment where you had so much of a concentration of housing activity after the pandemic first hit, and that probably pulled forward activity away from, the current environment. So housing, I do think, is under a significant amount of stress, and that's a market that should continue to adjust. But that's, in a way, by design. I mean, the Federal Reserve increasing interest rates, part of how they're transmitting that policy is through interest-sensitive sectors like housing.
So, Michelle, it begs the question, how far does the Fed actually have to go? The market seems to be pricing in something different than what the Fed and many economists are actually saying. How far does it go, and what's the impact on the consumer?
So I think they got some good news with the last CPI report. That was a real comfort in that you started to see signs of a moderation in some of the biggest inflation pressures, and not just energy, right? Because the Fed can't control that. They're hopeful that they'll continue to have some relief in terms of gas prices, and it looks like that's happening, but that's out of their control. But what they are trying to lean on is where there's excesses in the economy. And when you look at goods inflation starting to moderate, particularly things like if you look at used car prices, which has been an area of extraordinary price pressure, that's starting to come down. So I think if we continue to see that trend where, you're starting to see inventories build, you're starting to see some price discounting, and you're starting to see that moderation of growth that takes out some of that price pressure, that's going to be a nice relief for the Fed. Because at the end of the day, their primary goal is to get to price stability. They need to see further progress on that. So by no means are they done in terms of hiking. They will be continuing to bring interest rates higher, but they're going to try to, course correct depending on what they see for that inflation data.
Michelle, final quick question. What do you think Wednesday's retail sales number looks like?
I think it's going to be a strong report. I mean, if we look at what we saw for July in our spending pulse data, the consumer actually was out there spending, and spending accelerated between June and July when you look at it on a year-over-year, 3-year growth rate. So I think the consumer is still very much engaged in July, and that should show through in the retail sales numbers.
Hey, Michelle, really appreciate it. Thanks very much. I did not buy on flash sales today. I'm just saying. I'm paring back. Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist. Always good to catch up with you. Thanks for joining us. All right, coming up, following the conversation, a surprise rate cut from China's central bank that says the new data shows the economic slowdown is getting much worse. We're going to talk with Chen Zhao, Alpine Macro co-founder and chief global strategist next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Lisa Mateo. Iran is promising to respond by tonight to a draft text to revive the 2015 nuclear accord. Iran's foreign minister says if the U.S. shows a realistic approach, there could be an agreement in the next few days. A deal could let Iran resume oil exports to global markets. The UK has granted the world's first approval for a COVID shot tailored toward an Omicron variant. Moderna's updated vaccine contains a half dose of its original shot and the other half targeting an earlier version of Omicron. The company says it's also been found to generate a good response against the latest subvariants. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
All right, thanks so much, Lisa. Let's get to some of the economic data here. China unexpectedly lowering key borrowing costs. You got retail sales, industrial production, all missing forecasts. Let's get more into the details here with Bloomberg's Tom Orlik. Hey, Tom, can you give us, how bad was the data? Can you just give us perspective of that? And sort of what do your models show you then about the growth we can expect?
So there was some troubling data out of China on Monday, Alex. Industrial output, retail sales, fixed asset investment, all slowing, all missing expectations. The biggest drag, what's happening in the property sector. A 30% slump in home sales, and that now dragging on the property construction, which is one of China's main drivers of growth. Now, China's central bank has responded to that with a surprise 10 basis point cut in their main policy rate. Now, that was a surprise. The markets were expecting the PBOC to hold. It signals China's determination to do something about this slump in growth. On its own, though, a 10 basis point rate cut is not going to be adequate to the challenge.
Okay, so let's just talk about this. Surprise 10 basis point rate cut. If you say surprise rate cut, I get excited. You say 10 basis point rate cut, I don't get excited. So what is the signaling that comes from a surprise 10 basis point cut, Tom?
So I think you got it right, Guy. The signal here is surprising, and if you're worried about China's growth, positive. The substance, 10 basis point rate cut to address a 30% drop in home sales and a 7% drop in property construction, well, clearly that isn't enough. So the question now is what comes next? We think there's a little bit more to do in terms of rate cuts from the PBOC. We think there's more to do on the reserve requirement, freeing up bank funds for lending. The crucial pieces, though, are going to be what happens on fiscal policy, how much new money is there for governments to do the infrastructure spending, which China often turns to lift the economy out of a slump, and what's going to happen on policy on the property sector specifically. Let's not forget that this slump in the property sector is by design. China's policymakers are deliberately trying to squeeze the air out of the bubble. Is there a point at which they say, okay, the pain here is too much, we need to release some of these controls, we need to give developers a bit more breathing space, otherwise we're heading into a systemic crisis?
Yeah. When people stop paying their mortgages, maybe that point may have arrived. Tom, great stuff. Thank you very much indeed. Tom Orlik of Bloomberg Economics. It's also worth pointing out that Tom is also the author of China, The Bubble That Never Pops. The second edition is going to be released later this month. It sounds, it is very appropriately timed. For more now on the Chinese economy, we're joined by Chen Zhao, Alpine Macro co-founder and chief global strategist. Let's talk about this economy and what is happening. The data don't look good right now. Can you put this data in context for me? We are now getting a policy response. How much worse does it have to be before we get a full throttle policy response?
I think the number is bad. There's no question about it. If you look at all front, it's all very weak. But I think you have to also you have to also pay attention to the fact that if you think about the Chinese production side, the Chinese production side actually is stronger than the demand side. The reason I'm saying that, if you think about the Chinese export, and actually the number that are released a few days ago was very strong. We're talking about double digit. Whereas if you think about retail sale, everybody understand the number, 2.7%, but actually that is a nominal number. If you think about the real number, you have to take out inflation. Most likely, the Chinese consumption have already grown at 0%. So we have a pretty stagnant domestic demand, but at the same time, supply side is doing reasonably well. That's my feel. Yeah.
Hey Chen, it's good to see you, by the way. What does Xi do? What is Xi thinking? How is this solvable?
I think the problem here is that he's a strong man. There's a strong man syndrome. He does not care. For example, the property, as your economist just pointed out, the property market is really in deep trouble. And we know that lots of people don't want to pay their mortgage anymore. And you can see the sales are slumping. And then the Chinese government really does not really care about it because Xi Jinping already told the people, the public, that the property is for people to live in, not for people to flip, meaning not for you to sort of speculate. So that's why I think you can see the policy response to that is very, very muted. So I think it's your economist is absolutely right. I think the property slowdown or controlled implosion is by design. It's not really out of panic. You can see that there's no panic in the Chinese government. Even the rate cut is like 10 basis points is nothing. It's completely joke, in my view.
Okay. The authorities seem to be leaning on the authorities seem to be leaning on the banking sector. The idea being that the banking sector can extend more credit, it can allow the developers to finish properties, those properties can then be solved, and this controlled implosion can work in a controlled fashion. Does the banking system have the capacity to extend significantly more credit, though? How tapped out is the Chinese banking system?
So you got to understand one critical thing here that is very different from us in the West, which is the Chinese state-owned commercial banks. Their balance sheet is interconnected with People's Bank of China. So that's why you never see a banking crisis in the state-owned enterprise, in the state-owned banking sector, because their balance sheet is completely connected with People's Bank of China. If you have a bad loan, the People's Bank of China will provide unlimited amount of liquidity to all those state-owned banks. So that's why I think we should put that under arrest, meaning on arrest, basically saying the Chinese banking system is going to go into a major implosion. I don't think that's going to ever happen.
So, Chen, here's my question is, why don't the markets care? Like, I appreciate the fact that commodities are getting squashed, and that's definitely in reaction to the data. But this is a relatively bleak picture that we're outlining here. And I'm just wondering, like, where should the reaction be felt, and when should that reaction be felt?
Yeah, I think it's a very good question here. I think the slowdown or the near stagnation of the Chinese economy is actually very good for global fight against inflation. After all, we need a cooler demand, a stronger supply. That's exactly what you got from the second largest economy in the world, which basically saying the Chinese demand is really, really crappy, whereas the supply side was doing reasonably okay. So that is good for global fight against inflation, number one. Number two, if you think about it, commodity prices. I mean, it's really bad for commodity prices if you think about the Chinese economy, the performance of it. So I think from that regard, it's also good for inflation coming down around the world. In addition, I do believe that what's going on in China, what is going on in the Chinese economy is very bullish for the treasury bonds, because it's really the Chinese economy has to pump a lot of disinflationary pressure into the global system because they don't have domestic demand. They have to rely on the global demand to let the production machine running. So that's why they're probably going to cut prices. They're going to disinflate, which is working out actually quite well for the global inflationary story. So I think commodity is a pretty negative for commodity. That's a pretty given. And finally, I think it's going to be marginally bullish for the U.S. dollar.
We're going to leave it there. Great to get your insight as ever. Chen Zhao, Alpine Macro co-founder and chief global strategist. Sir, thank you very much indeed. Bit of breaking news while we've been having this discussion. London's Heathrow Airport announcing that it's going to extend the capacity limits that it has imposed in the early part of the summer through the whole of the rest of the summer. We're going to take this to October the 29th, basically limiting carriers' capacity to sell extra seats. We're kind of circa around 100,000 passengers going through Heathrow on a daily basis. They think they can cope with with that, but clearly they're struggling with hiring because they are now extending. Now, this is not the first airport that has done this. Schiphol Airport in Amsterdam has also extended its capacity limits. Others are likely to follow as well. Heathrow, just one of a multitude of airports that is suffering significant shortages. We'll continue the conversation, I suspect, as we work our way through the summer as to how long this is ultimately going to last. But at the moment, October the 29th, the new date for Heathrow. This is Bloomberg. European stocks are higher, energy stocks are definitely not. Brent crude is down by circa 4%, we're trading 94.23. The dollar is stronger, euro dollar back trading with a 101 handle, 101.95. The European close is next. This is Bloomberg.
talking about that all day yesterday.
Monday the 15th of August, European stocks go sideways, but the macro story becomes more difficult as the Chinese data emerges weaker than anticipated. Oil sharply lower. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Thirty minutes to the close. This is the story right here. Brent crude, the global benchmark, down by over 4%. That is in response to the Chinese data. It's not the Empire data, it was the Chinese data that really caused this. It started first thing this morning here in Europe, and we've seen a big move lower. Energy stocks, commodity stocks on both sides of the Atlantic are weaker as a result of that. Despite this, the Stoxx 600 is actually higher, but it's the defensive names, healthcare, etc., bouncing back quite strongly. Names like AstraZeneca having a really good day. Currencies are weakening. The dollar is definitely back on the front foot. 101.94. We're back with the 101 handle for euro dollar. The dollar is certainly in the driving seat right now, Alex.
Well, here in the U.S., Guy, let's take a look a little bit more about the repercussions of that weaker oil price. WTI now has an 8 handle. We're at 88. I mean, this is a severe downturn for the oil price. So the S&P, though, holding on, just down 0.4%. Despite the terrible data that we got from the Empire manufacturing data as well as NAHB housing market index, there is some still resiliency. In the oil market, though, S&P Energy Index is the weakest sector within the S&P, down a whopping 3%. Bed Bath & Beyond is up just because, I don't know, it's up 11% because the meme stocks are still a thing. Even AMC and GameStop are still holding up relatively well. And Freeport is the worst performing stock within the S&P, Guy, because it's not just about oil, it's also about all commodities on that China data. Copper really getting taken out. Nickel's down almost 5%. So this is really becoming and is a commodity story, but the filter through seems relatively isolated for now on that.
Absolutely. From a European perspective, all of this is terrible news. The Chinese economy is slowing and slowing rapidly. That is certainly evidenced by the data that we've seen today. China is a huge export market for Europe. Europe's also got its domestic problems that it now has to deal with as well. Domestic power prices continue to jump to fresh records. The energy crunch continues to deepen. We are a little ahead of where we should be in terms of gas storage, but nevertheless, if the Russians turn the gas off, that won't be enough. And then you've got the drought to factor into all of this as well. We spent last week talking about this, and it continues. Don't think that it's gone away. It may rain this week, but it's still going to be difficult for the Rhine River, and it's likely to remain impossible for quite some time. We're now at -8 centimetres below the 40 centimetre limit, Alex, where the Rhine can be navigated. So it's still falling. Some stabilisation maybe, but it's likely to remain tough for really